You know, ever since the 2008 financial crisis, there's been this one massive question hanging in the air. How do we make sure our banking system can actually survive the next big storm? Well, the answer isn't just about piling up more cash. It's about being able to see the storm coming. So today, let's pull back the curtain on the incredible tools that regulators use to do just that. Think about it this way. Meteorologists have these super complex models to simulate hurricanes, right? They predict the path, the intensity, and that helps us all prepare. Well, banks need the exact same thing for the economy. They need their own hurricane simulator, but for a massive economic downturn, a financial hurricane, if you will, to see if they can actually take the hit. And that's exactly where credit risk models come into play. Now, these are not your average spreadsheets. They are seriously powerful simulation engines. Regulators like the Federal Reserve use them to run what they call stress tests, where they basically throw a hypothetical crisis at the banks to project how many of their loans, we're talking everything from mortgages to credit cards, would go south. So how in the world you build a financial storm simulator? Well, like any complex recipe, you've got to start with the right ingredients. And for a credit risk model, the most important ingredient is data. The very first step is understanding a simple truth. I mean, it's just common sense, right? A mortgage for someone with a near-perfect credit score is going to behave way differently than a high-limit credit card given to someone with a bit of a shaky financial history. Same goes for a loan on a brand new car versus a 10-year-old one. So the model's first job is to bring some order to all that chaos. And this really critical sorting process has a name. It's called segmentation. It's all about grouping similar loans and similar borrowers together. That way, the model can analyze the specific, unique risks of each little group. It's kind of like sorting your hurricane supplies. You put the water, the batteries, the food into different piles so you know exactly what you're working with. And this is a perfect example of how it works in the real world. Let's take auto loans. The model digs into all the detailed data the banks have to report. Then it starts slicing and dicing. It segments the loans by things like the borrower's original credit score, the loan-to-value ratio. That's how much you borrowed compared to the car's worth, and even whether the car is new or used. Each of those segments tells a completely different story about its potential risk. And let me tell you, these models are hungry for data. They just gobble up enormous amounts of it. We're talking about everything from the bank's own super detailed reports on every single loan to data they buy from third parties on things like commercial real estate. And most importantly, they study tons of historical data from past recessions, trying to learn the lessons from yesterday's storms to prepare for tomorrow's. Okay, so we've gathered all the ingredients and we've sorted them neatly. Now it's time for the fun part. Let's fire up the prediction engine and see how this whole machine actually works. You know, building these models isn't just about pure math. It's also about making smart, deliberate choices. For example, in the model for corporate loans, the absolute riskiest companies all get lumped together into one group. Why would they do that? Well, this little quote from the official documentation tells us everything. It's a practical call driven by a lack of good historical data. It's a classic trade-off. You sacrifice a little bit of detail to get a more stable and reliable prediction. And this is a fantastic example of just how sophisticated these methods can be. For home equity loans, they use something called a state transition model. Picture this. A loan starts out in a happy state, let's say it's current. Then the model applies stress. It simulates the economy getting worse. Maybe house prices start to fall. And then it calculates the probability that the loan will transition to a new state, like becoming 30 days late on a payment, and then maybe 60 days late, and so on, quarter by quarter through the crisis. So what are these stresses the model applies? Well, think of them as the knobs and dials on the financial hurricane simulator. The whole macroeconomic scenario is built on variables like the unemployment rate, GDP growth, and housing prices. These big picture drivers are what connect the fate of one single loan to the health of the entire economy. Okay, the simulation is done. The engine has crunched all the numbers. So what do we get? This is where all that mind-boggling complexity gets boiled down into a few absolutely crucial insights. First up is the probability of default, or just PD for short. It's pretty much exactly what it sounds like. For every group of loans, the model spits out an estimate of how likely it is that those borrowers will default under the really tough economic conditions. It's the how likely is it to happen part of the equation. But okay, what if they do default? How bad is the financial hit going to be? That's the next piece, loss given default, or LGD. See, if someone defaults, the bank doesn't always lose 100% of the money. They might be able to repossess a car or foreclose on a house to get some of it back. LGD measures how severe the loss is after you account for whatever they can recover. And the third piece of the puzzle is exposure at default, or EAD. This is all about figuring out the total amount the bank is on the hook for at the exact moment a borrower defaults. This one is super important for things like credit cards and lines of credit, where someone might max out their entire credit line right before they stop paying. And here is where it all comes together, in this simple but incredibly powerful formula. The model takes the probability of default, multiplies it by the loss given default, and multiplies that by the exposure at default. And what you get is the expected loss, the final bottom line dollar amount the model predicts a bank will lose on that group of loans. Now, I know that was all pretty technical with a lot of acronyms, but these numbers aren't just for some report that sits on a shelf. They have a massive real-world impact. They are right at the very heart of keeping our entire financial system stable. Because at the end of the day, this is what it's all about. By simulating these financial hurricanes, regulators can make sure that banks are holding enough capital, enough of a cushion, to absorb all those projected losses, and, crucially, keep lending money, even in a really deep recession. It's all about preventing another 2008 and avoiding taxpayer bailouts. But, and this is a really important but, these models are not magic crystal balls. As sophisticated as they are, they're built by people, and that means they are built on assumptions. Understanding those assumptions is absolutely key to understanding both their power and their limitations. In fact, let me show you a fascinating example with just one single number. 75%. What in the world could that possibly refer to? Well, that 75% represents a core assumption that's baked right into the model's code. For certain types of corporate credit lines where good data is hard to come by, the model doesn't even try to predict the exact amount a company will borrow before it defaults. Instead, it just makes a simple, conservative assumption that the company will have used 75% of its available credit. It's a perfect example of human judgment stepping in where the data runs out. And this leads us to the final and most critical question of all. These models are incredibly powerful, but they learn from the past. They are trained on data from recessions and business cycles that have already happened. So the million-dollar question is, what happens when the next financial hurricane is a completely new kind of storm, one that looks nothing like the last one? That is the fundamental challenge that keeps modelers, regulators, and bankers up at night.